Welcome back, guys, to another roundtable. My name is Adam. With me once again, I have Rusmin.
Hello.
And Victor.
Hi, everyone.
Thank you so much for joining us. And today we're going to talk about the investment quadrant. So what is that? So I realized that we've actually written an article on the investment quadrant many years ago, updated it along the way, but we've never actually talked about it on the roundtable. So I thought this was a perfect opportunity to have a chat about this and what exactly is this investment quadrant. All right. So I think some of you may be familiar with Robert Kiyosaki's famous book, The Cash Flow Quadrant, where he kind of divides how people can basically make money.
Yeah.
And for us, this investment quadrant is an investment process that we use to basically analyze almost any single company that we come across out there.
Yep.
All right. And it basically has 4 quadrants. All right. So we have the business, management, financials, valuation. And just like the cash flow quadrant, I think if you remember in Kiyosaki's book, he was saying on one side of the quadrant, you have people who exchange time for money.
Yep.
Yeah.
And the other side was people who use money to make money, right?
Yep.
So same thing for our investment quadrant. You can see on the left side, you have business and management, which is our qualitative aspects of analyzing a business. And on the right side, financials and valuation, you have the quantitative aspects of analyzing a business. And I would say the left side is a lot more important.
Yeah, so
Yep.
I think we focus a lot more on the business and management. At the end of the day, I think your financials is created by your business and management.
Yeah.
Yep.
So I think a lot of beginners actually tend to focus a lot more on the
On-
numbers at the
Yep.
start.
I
Because
think
it's easy
that's
to pick up.
the easier way to start,
Yeah.
right?
it
Because
is,
the
it is.
business and management requires you to build your experience throughout the years. It's not immediately that you understand
That's
what's
true.
business model, how to spot management that, telling the truth or are they lying and all this,
Yep.
right? Yep.
And it takes time to kind of understand the business model and all that.
Yep.
So we're going to go through this investment process. So if you don't have something that, a system for you to work with to help you analyze any stock out there, you can make use of this one. We're going to go through the whole quadrant, all 4 of them, step by step, so you can use this for yourself. All right.
Yep.
So we're going to start with business, which I think is the most important quadrant. So tell us a bit more about what the business quadrant is all about.
I think the business quadrant is focused a lot of understanding the business, how the business actually makes money itself, right? Because when you look at business, right, there's many types of business model, especially in the world or especially in the stock market, right? So not every businesses are investable, I would say, right? Because some business, they exist because they are good for the economy, but they may not be a good investment. Right, but there's some business that they are good for the economy, but they are good for investment, right? So, for example, I think especially the airline industry, right, is very competitive. It's like you got very good airline, like for instance, they are like the Ferrari, but you're in a traffic jam, right? Massive competition, right? So airlines is essential for the economy, but as an investment, I don't think it's a very good investment. So we in this business part, right, we need to understand what business are good for investment and what business are just good for economy, and that's how we differentiate it under the business quadrant.
Yeah.
Then after that, we want to look for companies that have economic modes, right? I think Warren Buffett explained very well about the economic mode is like your castle. You have a castle, then you have the river around surrounding your castle, right?
Which is the moat, yeah.
Which is the moat,
moat,
right?
yeah.
So you have a lot of goals in the castle, right? So every time your enemy attack, if your moat is very weak, enemy can attack and take away your goal, right? But if your moat is strong, you can maintain your goal while you go on and attack and get somebody else's goal, right?
Okay, so it's kind of like protecting your profit and trying to eat market share as well.
Yeah, correct.
Yeah.
So I think that's a very good analysis, and a lot of times we need to understand, what kind of companies do they have economic modes and what are the different types of economic modes. So I think there's a lot of types, but I think one of the most common type of mode right now because of the internet is actually your switching cost mode, right?
Okay.
So for instance, let's talk about this company called Adobe, right? So for instance, Adobe, they have this thing called, I think it's Creative Cloud, am I right?
Yeah.
Yeah, Creative Cloud. So you subscribe them on a subscription basis. So and you can ask anybody who use Photoshop, right, whether they can change out of Adobe, right? It's very hard. I mean, you have friends
Adobe.
that have that?
I mean, I can't even switch from like Windows, man. You guys use Macs. I have no idea why.
No, you can switch out from Windows.
No, I can't. But there's a switching cost, right?
Yeah.
And I think it's even higher
Yeah.
for someone who uses creative software
yeah.
like Adobe, which is a lot more complicated.
Yeah, because you kind of have to relearn all the features.
And that takes years to be expert at something.
There's a very, very steep learning curve. So once you learn, you don't want to change it, right?
I think for most people, the easiest way to understand is the Microsoft Office, right? Just think about other Office software out there.
You guys use Microsoft Office
on
your Macs.
Oh, yes.
So once you understand the mode, the next thing is you want to understand how competitive the company is in the industry, right? Whether they are a big fish in a small pond or a small fish in a big pond. Because at the end of the day, right, you need to understand this, because all these things that you understand will link back to the financials, right? So the financials tells you what happened in the past, but what happened moving forward is going to come from the business and the management itself, right? Then after you know about the economic mode, you need to know what are the possible growth drivers, right? The catalysts that can push up the revenue or the net profit of the company. Whether the company is having a circular uptrend, right, in their industry, or are they going for a sunset industry, right?
Yeah, I think COVID was a great example of trends that really accelerated because of the pandemic, and a lot of companies really rode that. Some of them rode them too high, and then it's come back down again. But I think those trends are here to stay. Those are structural things.
Digitization, right?
Yeah. So we also need to understand what's the difference between growth drivers and growth plan, right? Because a lot of times, when you link back to the management, right, your management always tells you a lot of what are the plans they are going to do it.
Everyone's going to say nice things about the business, right? Everyone's going to say the wife is the prettiest.
And all these plans needs times to happen, right? So what we want to look for is growth driver, not growth plan, right? So that is the
So what you're saying is growth drivers are real things that you can observe and measure.
It's already happening.
It's happening that can really push the company to the next level.
Yes, correct.
And you're saying you define growth plans as something that the management is just
planning to do, but it's just at this moment it's just a plan.
They're still building castles in the sky.
Because there are a lot of entrepreneurs out there tends to sell dreams, right? Which is not even a reality.
I mean, it's part of the job, right?
It's part of the job.
You have to do that. Yeah.
You need to get more people.
But you need to be discerning about what's really concrete,
correct,
and what's still up in the air. Okay.
So after you know all this, right, the main thing that you need to know is also the risk of the business, because every business, right, any business, there's definitely risk. There's definitely risk that will really affect their revenue or their net profit, or maybe cause the company to bankrupt. So you need, before you even invest in the company, you need to identify all these possible risks, right? So anytime when this risk happen, right, you immediately knows the situation and you can take immediate action.
And you have to be comfortable with those risks, because there's no company with no risk. That doesn't exist. So every company has risks, and if you're going to invest in that company and you know those risks, you have to be comfortable with those risks and sleep at night.
So I think that when it comes to risk, right, you also need to understand the number of risks that the company have. Because some businesses, they are very good, they got very minimum risk, right? They got just a few risks that can move their revenue or net profit, right? But some business, they have multiple risks. So when you have multiple risks, right, this type of business, right, we want to have higher margin of safety. Now you can see that the business is linking back to the valuation. So even though we are explaining each segment by individual, right, but actually if you were to link, right, they are all linked back to each other.
That's why it's a quadrant. It's one system that we use all together.
Right. So it's not just individual, it's all linked back, right?
All right. So that's the business.
That's the business.
All right.
So I think, of course, after you found a good business, almost like having a good Ferrari, you want to make sure the driver in it is handsome.
It's a good driver.
It's
handsome. There's no point being handsome when you can't drive.
True. So that's the main point, right? So you want to have capable drivers, basically the manager who run the car, run the business, right? So typically these are the people who want to make sure that they have skin in the game, right? So you want to make sure that the owners or the CEO, CFO have about their will actually tied closely to the company. So it is in their alignment, it is in their interest to make sure the company perform well. So as a shareholder, we are pretty much on the same page, right? But having that said, that's one thing. Secondly, of course, you want to make sure that some companies, especially in Asia, a lot of entrepreneurs list their companies to not to make money for the shareholder, but to make money from the shareholder. There's a big distinction there.
Cashing out in a sense.
Cashing out in a sense. So that is also the part where, as an investor, you want to check out, whether are they paying themselves too much. Because there's the way for them to to cash out. Okay, and
But it happens in the US as well.
that happens in the US. But in Asia, I think the Asian entrepreneurs are a lot, I would say, more sly. So I mean, we have gone through, seems quite a lot of companies that are barely making profit, and yet they are paying themselves millions, which is something that is not a good thing as a shareholder. When you look at them, they are not making money for you, right? So that's something that you also want to be able to find out. Okay, and of course, we also look at things like whether they are buying in time of crisis. So in the recent example, we talk about, I think, Starbucks, right? The founder, Howard Schultz, has been buying back share, which is kind of give you a clue that this founder is taking out his own money and then buying back share.
And this guy have a track record of already turned around the business.
Yes.
You get what I mean?
Yeah. Of course, there's a succession risk because this is the second time that's happening, right? So these are the things that we look at as a shareholder. Of course, the fourth thing, of course, you look at the allocation behavior. Okay, whether the management know what to do with the dollar profit that they make. Do they buy back shares, or do they pay out the dividends, or do they reinvest it? Right, or do they use the money to buy Bitcoin? Which is, I mean, it could not be may not be.
Who are you trying to say?
I mean, there's so many. I don't know.
Wow, I mean, the obvious one is of course Elon Musk, right? I mean, as an investor, I wouldn't want to invest in Tesla, although that company has made a lot of money for Tesla shareholder. But obviously, there's also a case where Elon Musk is trying to run so many companies at one go. Although he's really a smart guy, but at the same time, he can be quite problematic in the media, right? So
I mean, I guess Tesla investors, they should be aware of those risks and be comfortable with them. And some of them are really comfortable with whatever is happening.
Yes. And the whole Tesla is Elon Musk, right? So if anything happens to him in the worst case situation,
it's a key man risk.
Right? So these are the kind of things that you really want to pay attention. Of course, there's one more part where we like to pay attention, especially in Asia, again, is related party transaction, where a lot of fraud occurs, right? And this is an area where I think a lot of investors never really pay attention, right? Because it's also a way for the entrepreneur to funnel the money outside of the company after they list it. Right. So there are many ways to do it. One of it, of course, through transaction with the entity that belongs to the founder, privately owned. Of course, they have to disclose it, right? So, and as an investor, of course, you need to know how to find this information. Which you're gonna separate between a good driver and a bad driver. So ultimately you want to invest in companies that have good manager, and they don't take advantage of you at the end of the day.
So I think at the end of the day, what we are looking for is management that we can trust, right? And also tracking their behavior, because a lot of management, they sell you dreams, like we talk about the growth plan, right? At the end of the day, we should focus on this sentence called "well done is better than well said," right? Focus on their behavior rather than focus on what they say.
Did you learn that from the army?
No.
I hear that all the time when I was in the army.
Is it?
Well done is better than well said.
Well said.
Okay, so after you get the hang of the business quadrant and the management quadrant, then you comes to the financial quadrant. So at the financial quadrant, what you are look out for is actually the standard metrics, like your gross profit margins, your net profit margins, whether the revenue and net profit is consistent. These are the initial filters that when you look at the financial quadrant side to get it, your ROE, your return on equity, whether they are cash flow positive, whether they have high cash, low debt, or high debt, low cash, and all those like capex that you need to use, right? So all these are basic numbers that you can see when you look at the financial quadrant. And usually when most beginners, right, they will go straight to the financials to screen out all the companies. But like I explained, in the end, the financial quadrants, right, or the financial numbers is created by the business and the management. Whatever you see right now, based on the past track record, right, is backward looking, right? Like what Buffett always said, you drive the car, but you look at the rear view mirror, right? The business and the management is the forward looking one that will create the future number. So at the end of the day, you can get good business out of looking at financial numbers, but you still need to look forward to the future by focusing a lot on the business and the management, right? So after you look at the consistency, if everything is consistent, basically it's easy, right? But if there's one or 2 years, there's some spike, that's where you need to go and find out what happened is down there, and you want to remove all those exceptional items. Then after the financial quadrant, we will move on to the valuation quadrant, which is usually done at the last part. You don't immediately do the valuation at the first part, right? You need to understand the business, the management, the financial, then finally the valuation. So when it comes to valuation quadrant, right, we have always a phrase. Why valuation is important is because a great company can be a bad investment when purchased at the wrong price. Right. So buying the company at the right price is very important. So for instance, if you look at Coca-Cola in I think 1998, they picked in 1998 at a very, very high valuation, 40 over time. At the point of time, Coca-Cola is almost around the world already.
I think it was 40 times price to earnings, you're saying?
Price to earnings, yes, correct. And that peak price, right, took you about, I think, 14 or 16 years to break even back to the same price if you have bought that, right? Because the valuation was very high at the point of time. But if you have bought Coca-Cola, when it drops, crash it down, and you have bought throughout the years, your return should be much better than that, right? So buying at the right price is really very important. You will learn how to value them, because there's a lot of valuation metrics, your PE, your price to book, your PEG, your price to sales, your price to cash flow, and also some people, they use the discounted cash flow model and all this.
Speaking of this, of course, last year 2021, I think it's also one of the years where
2 years ago, man.
Yep.
Yeah. So so that was one of the year where I think we saw a lot of high tech growth companies that are trading at high price to sales, not even price to earnings.
I mean, that 2021?
2021, yeah.
Okay.
So they are trading above 50 times, 100 times, right? So today, you look at them, a lot of them have been corrected at least 80, 70% down, right? So that speaks a lot about valuation. When people start to ignore about valuation, they overpay for things, and usually ended up with big, massive losses. Right?
So having the right valuation is very important, like what Rusmin said, because I remember last year, 2021, we basically do nothing because
we just did research, but we're just waiting by the side.
We dabble a bit,
just a bit here and there, but there's really very, very few ideas to look. A lot of people ask us, what should you look at and all this. We say that you should be more defensive on 2021, but this year I think we are slightly becoming more aggressive because recently the market have entered into the bear territory.
So we were quite aggressive, I think, second half of last year on Chinese tech, mainly because valuation was very attractive, right? And the business of those companies, the managements are pretty solid as well.
Yeah, I think the thing with valuation is that when you do the whole, I guess when you're new to this thing, finally found a system that works for you and makes sense, and you apply it, and then you found a great business, great management, great financials, and you just want to buy straight away because you're so excited about buying something, finding something.
Yes.
That you just want to own it straight away, but you got to wait. You hold your horses and wait for the right price. I think because that lesson is really important, because if you're not able to control your impulse and you just want to buy all the time, you can get in a lot of trouble in the stock market as well.
Correct. You really have to determine the stock value, what we call it, intrinsic value, right? Using all those valuation methods that I just mentioned, and most importantly, to buy it with a margin of safety, because at the end of the day, as much as we want to predict the value, sometimes we may be wrong also.
And things can change.
Yeah, correct.
The future is unpredictable.
Yeah, correct. So if you have a margin of safety, right, you buffer for any possible events that is unexpected, right?
Yeah.
So basically, this entire quadrant is what we use to, I think, apply to analyze almost any company out there.
It is a framework that we use to analyze any companies out there, and also a framework that we use to build our conviction, right? So in the case where there's a market crash, the company share price dropped 20%, this is where our conviction come from, because we have done the research, we have used the framework to analyze those companies, and this is where we will not be panicking when other people are selling.
So you've done all that work to go through this whole thing.
I mean, we've gone through so many roundtables, right? So a lot of time you hear us talking about a lot of companies, but actually behind these companies that we analyze, actually this is the framework that we use to analyze them.
And when we talk about these companies, I mean, the roundtable is like 15, 20 minutes. It seems like we're just sharing easy stuff about the company, but it took like months, and sometimes even years to understand this company and just distill that information and that context in the way we understand it. That makes sense for us as an investment.
And this is a very comprehensive framework, and those roundtables that we share usually are more brief in summary, right? So, I mean, a company we analyze, we can take about an hour to present.
So anyway, this is just the surface of the investment quadrant. I mean, we gave you like the headers, I guess. But how do you do all these things really takes practice. You need a system. And if you're looking for a system and you've been like chasing I guess stocks all this time because someone told you to buy this because this looks sexy, you can kind of like stop and use this right now. If you don't have anything like that. So actually, this whole investment quadrant system actually comes from our course called Investment Quadrant. Okay, it's the same name. All right, which is actually open right now. So as you know, we don't really open our courses all the time. We open it once a year. So at this point in time, we're opening Investment Quadrant. You can go to investmentquadrant.com, and we basically teach this entire process based on this investment quadrant to basically analyze the stocks that we analyze.
Basically we show you how to do it, right? So I talk about their pay. Okay, where do you look at, right? So these are the things that you learn in the investment quadrant. Ownership, right? How much stake the insiders own. If you don't know where to figure this out, okay, so investment quadrant is where it's going to show you.
It's like puts everything for you in a step by step.
And also the valuation. Oh, how do you calculate PE, PB, and stuff like that.
And also, I think basically we just shared the quadrant itself, but on top of the investment quadrant, we also have teaching you how do you look for ideas, right? And also when to enter and exit. How do you see whether the market is expensive, cheap? When is the right time to enter the market, right? And when is the time where you want to be more defensive, right? Do not enter don't enter the market, just nibble a bit. And also we want to talk extensively on the portfolio management also. And on top of that, we also do have a live webinar during the once a year open investment quadrant, which you can attend unlimited as long as we conduct the webinar every year, right? Right. So, and also there's some Q&A questions where you can ask us unlimited. I think there's a lot of questions in the investment
quadrant. You're answering questions almost every day.
Yeah, correct. So as long as you ask question, I'll be there. Usually take about 1 or 2 days for me to answer.
So I think that questions are an important thing, because I think even if you have a system, it's kind of like straightforward, step by step. You're bound to have questions. You're bound to have like, does this make sense? Does it make sense? And you and Rusmin are there for these guys as well.
And also during the live webinar, we also do share live investable case studies that you can look at that we think personally, in our own opinion, is undervalued right now.
All right. So if you're interested to find out more about the investment quadrant, if you're looking for a system that you can apply for yourself to invest in the stock market, do check out Investment Quadrant at investmentquadrant.com. We'll put out the link so it's easy for you to go there. It's open right now till I think 10th of July. So that we'll close it right there and then the next time it reopens will be next year. So we open it once a year. If you want to check it out, please go check it out right now. So by the time you're watching this, I don't know if it's still open. All right. So go to investmentquadrant.com. So I guess this is pretty much what investing is all about. You do need a system to make things as predictable as possible,
repeatable,
and repeatable.
Yes,
kind of like a factory. Is a quality controls in place rather than trying to like throw something together and you get lucky once in a while, but then you get hit most of the time. So I think that's pretty much it for this roundtable, right? All right. So once again, my name is Adam. That is Rusmin. This is Victor.
Thank you
so much for joining us, and I hope you really learned something, especially if you're seeking a system that can really help you get better results in the stock market. If you're really interested, just go to investmentquadrant.com. A lot more details over there, and of course it's going to be open for a limited time only. So once again, thank you so much for joining us. If you like this roundtable, please hit the like button. Tell us we're doing a great job. Of course, any questions, you can always put them in the comment section. And of course, subscribe to our roundtable. Many more, subscribe to our channel. Many more roundtables coming up as well. And we'd love to see you again. So take care and see you around.